Hey everyone, welcome back to the channel. In this video, we're looking at 5 potential causes for the next stock market crash or a slide in this year. The stock market right now at the moment is at near all-time highs, which sounds quite strange considering that the unemployment rate is still in the double digits and that we have so many people who are struggling to pay their bills. It's a very interesting time that we live in at the moment. We look at the NASDAQ at all-time highs, the Dow's creeping up on levels that it was earlier this year, and the S&P 500 is near up on the year as well. So what we'll be discussing today is some of the concerns that investors have about the markets for 2020. And I want to make it very clear that this does not necessarily reflect my personal opinions about where the market is going to be, but rather I just wanted to present some of the ideas that some people who are bearish on the markets have at the moment. And then in Wednesday's video, we'll be discussing 5 reasons why the stock market may continue to climb in 2020. So we want to give you both sides of the story so that you can hopefully make some decisions for yourself as to where you think the markets will be at the end of this year. So, of course, I'm not a financial advisor. I'm just a random person on the internet, but I wanted to share some of these ideas with you. So let's get started. Make sure you subscribe to the channel. Drop a like if you find value in this, and let's go. So one of the first concerns that people have about the markets is that if unemployment rates linger at a high level, that could significantly hurt the amount of growth that we could see in stocks in this year. So we just saw the May jobs report roll out just a couple of days ago. We saw that the unemployment rate is about 13.3%. This is a pretty high unemployment rate, especially when looking at the numbers from this time last year and then the stock prices from this time last year. I saw an interesting little chart. I'll throw this up here just to show you the differences between this time last year, looking at the stock prices versus the unemployment rate. And yes, the stocks are higher than what they were at this time last year, even though the unemployment rate added a 1 before that 3 there, which is kind of ridiculous. But keep in mind that stock prices, they're forward-looking. The stock market as a whole, it's forward-looking, whereas economic data is sort of looking into the past, historical figures, whereas the stock market is looking at the future. So that's why we see some of these stock prices higher. But a concern that people have is that if unemployment lingers at a high level, let's say in the double digits for many more months, it's going to negatively affect stock prices, or at least you would think it would, although this market is kind of difficult to predict. So what I want you to do is keep a very close eye on the June jobs report and then the July jobs report when that comes out in August. So this will be in the beginning of July when we see the June jobs report coming out. What you really want to pay close attention to is how quickly we can get that unemployment rate down. A lot of states have been opening up. We see some states like Georgia or Texas or Florida nearly entirely opened up, whereas other states like Pennsylvania and the eastern side of it, I mean, I still can't go get a haircut. Restaurants are closed, bars are closed. Pretty much everything's closed still in June, so I can't really do very much. So the unemployment rate here in Pennsylvania is still pretty high, but it's really going to be interesting seeing how quickly we can get that number down, the unemployment rate. And if it doesn't come down fast enough, it's probably going to weigh negatively on the stock market. Pay very, very close attention to that. There's also kind of this idea that maybe stimulus, all this federal stimulus, is sort of creating this false sense of hope, in a sense that, hey, if we have unemployment at 13% and we suddenly cut people off, there's no more stimulus, you're not getting that $600 extra for unemployment, it could really negatively affect people's ability to go out and buy, to be consumers and spend, which is what America loves to do, which pretty much drives the entire American economy, is consumerism in the country. So the second concern is that debt from some of these corporations that they've taken out in the past couple of months is going to catch up to them in the future. And so some people believe that we're in sort of like this false hope situation where it looks like a company is doing well because they got all their customers back. Maybe they opened back up, they opened their hotels back up, they're going on cruises again. But it creates this sort of false sense of hope because their underlying financials just might not be as healthy as what they once were. And this is actually one of the biggest mistakes that beginner investors make, is that they assume that if a company is pulling in the same amount of revenue as what they were previously and they have the same amount of customers, then they should have the same stock price as well. That is a terrible mistake to make. So for example, let's take Norwegian Cruise Lines. Let's say that in 2021, they're pulling in the same amount of revenue, the same amount of money as what they were doing in 2019. 2020 was just shit show for them, and it was a terrible year. But let's say that they get back to normal business operations. Now, some beginner investors just make the assumption that if they're pulling in the same amount of money, they're going on the same amount of cruises, that their stock price should also be at the levels at which it was in 2019. this is a major mistake that people make. And so the issue here is that the underlying financials may just not be as healthy as what they once were. So for example, let's say that Norwegian has to borrow money at a 12.5% interest rate for $600 million so that they can pay their employees, they can pay for their loans that they've had, because they're pulling in absolutely no money at the moment. Now, the 12.5% interest rate is quite high, and this can actually really affect a company's future profitability. So even if they're pulling in the same amount of money as what they were in 2019 or 2018, there's a good chance they're going to be less profitable, because most of the money that they're earning has to go towards paying off all of these loans and this debt that they've taken out during poor economic times. And I think this is actually going to happen to a number of different businesses around the world who were in a big situation, especially in the travel and tourism industry, where they had to borrow money at extremely high interest rates, and now they have to go and pay off all of that debt. So it's going to be a lot more difficult to see some of those stocks going up to where they were previously, or at least you would think that would be the case. And that is one of the concerns that some people have, is that we're sort of in this false hope situation for some companies, not all. I think a lot of companies are going to do just fine in the future, but some companies are in this sort of la-la land at the moment, where their stock price bounced up and they still are not very profitable. It's going to be very difficult for them to see profits in the future. And if we want to go down the rabbit hole of debt and defaults, we could look at the debt to GDP ratio. I don't think this is going to be that much of a concern, considering the cost of debt has also been extremely low, but we do see the amount of debt that we're carrying as a country as a whole and as consumers, it has been ticking up. And so this could be somewhat of an issue, or at least something that we do want to look at very closely before making decisions. But also default rates. I see people who have mortgages, or they have rent that they're supposed to be paying. They lost their jobs, and so they haven't been paying this. They've been deferring it. They've been pushing it off, forbearance, for the past couple of months. At some point, it's going to come back, and they're going to have to pay all of that off. If they've been in forbearance with their mortgage for 6 months, at some point they're going to have to pay that off. And if it's a $2,000 a month mortgage, that could be $12,000 at the end of that period of forbearance, or whatever they're doing for pushing off the rent. They're going to have to pay it eventually in most cases. And so that could hurt some people, which is going to hurt their ability to then go out and spend more money in the economy as a whole. And it could sort of put a damper on the economy. So looking at overall debt rates in America as well could be somewhat of a concern for some people. The third concern that people have is stock buybacks are probably going to decline, which might actually hurt the growth of some stocks. Now, this is a very interesting situation that we're in with stock buybacks. In fact, I believe that they were actually illegal in the US until about 1982. So from the 30s until 1982, they were considered illegal in most cases. But you could make the case that a lot of growth in stocks in the past decade has been driven by stock buybacks, which some people believe to be somewhat manipulative. So for an example here, to show you how some people view this as manipulative, let's say that a company can borrow money at 4%. Corporate bonds at 4%, they borrow that money, and then with the 4% borrowed money, they use that to pump up the price of their stock by 10 or 15%. So you can see from a corporation's perspective, this almost looks like a pretty good deal. They can borrow money at 4% and instantly pump up the price of their stock by 10 or 15% and essentially make money off of that. But the issue here that some people have with it is that if they're issuing corporate bonds and then they're taking that money and they're not putting it into something that could be producing cash, producing more assets in the future, that's kind of where the problem lies. So for example, there's no problem in a company borrowing money and then using that to maybe build new factories, put this into R&D, put this into some type of more production so that they can actually grow their revenue. They can grow their profits and become a healthier business. Instead of doing that, they're taking it and just buying back shares of their company, taking less shares off the market, and then just sort of falsely pumping up the price of their stock. This is an idea that some people have, and seeing that some companies aren't going to be doing this as much in the future could mean that their stock prices might not be as falsely pumped up as what they once were. Especially in the airline industry, I think that we're going to see this happen, considering that I believe the number was 94% of free cash flow from some airline companies were just being put into stock buybacks, consistently buying back in open market operations. But it is just something that you can go down that rabbit hole as well of looking into stock buybacks and how that can affect stock prices. I don't know if I totally agree with the sentiment that not having stock buybacks will not drive stock increases, because they're going to put that money somewhere. They're going to put that money into R&D or dividends or some other type of area within that company. So as long as they're investing it into something, I think it's still going to work out for a lot of companies. So like I said, I don't totally agree with that idea, but I have seen it being thrown around by a number of people. And then the fourth one, we're going to bundle a couple of those in this one for number 4. But one idea that some people have is that there could be another outbreak, another second wave. We're not going to get into this very much because honestly, I'm not a doctor. You're probably not a doctor either. And so we can all speculate about second waves or another outbreak or vaccines. We can talk about this at the dinner table all we want. But honestly, nobody truly knows where we're going to be with that. But it is a concern that we have seen a number of people having, is that we don't really know what's going to happen in the future, especially with this virus. And so it does create some reason for concern in the future, where maybe we have a little bit of some false sense of hope. I don't know. It is just one that we wanted to bring up. Now, the fifth concern that some people are having is the issue with actually being able to predict earnings for quarter 2, for quarter 3. And to accurately be able to predict those, it's sort of up in the air. And anytime that you can't really go off of a baseline, it's going to create more confusion, and it's difficult to properly estimate the value of a company. You can't look at earnings from quarter 1 and quarter 2 and say, well, a company should be valued at this level, because we're in totally unprecedented times at the moment. So you can't just look back on 2019 earnings and then compare them to 2020 and make a decision based off of that, because, well, the entire country, well, not the entire country, at least my area where I live, is still shut down. A lot of places in the world are still shut down, and we are in totally unprecedented times. So because of that, it's difficult to estimate things. And a lot of people base their investments off of projected earnings, estimating those earnings, and then if a company beats those earnings or misses on those earnings, it's going to weigh on the stock price quite significantly. But analysts are struggling to come up with accurate figures as to how much a company should be pulling in at the moment because of what's going on in the world. Now, one more concern among some investors is, and this is coming from Goldman Sachs, not from me directly, is that they see a rising possibility of a blue wave for the November elections, which could pose a risk to corporate profitability and dividends. If we see the reversal of some of the 2017 tax cuts, especially for those mega cap corporations like Amazon, who just doesn't pay taxes, if we see some of those reversals, it could affect stocks in one way or another. From some of the mega cap corporations, it could negatively affect them, considering that they might actually have to start paying taxes. And then for some smaller corporations, we could actually see some of them benefit. It really depends on your views on this, because there's positive and negative externalities to anything that occurs in the world. But make sure you are paying some attention to the election and understanding of what's going to happen in the future, if Joe Biden wins or if Trump wins, and how that might affect the markets as a whole. But if we do see a blue wave of Democrats having the House, the Senate, and the White House, we're probably going to see some tax increases for certain corporations or for higher earning individuals, which could mean that maybe some of those higher earning individuals will pull money out of the stock market before they get hit with those higher tax rates if somebody wins an election. It's just some food for thought that you can think about. But make sure you are following politics. I have a love-hate relationship with it. I love following it, but at the same time, I hate talking about it because it's just a hostile environment to ever voice political views. But that is this video. I think we're going to wrap this up. I got some avocado socks on. I should probably edit this part out, but all right, guys, I'll see you in Wednesday's video when we discuss some of the potential reasons for why we might see the stock market increase in this coming year as well. So thanks for watching the video. Appreciate all the support, and I'll see everybody next time.